Hello everyone, this is the 15th of May 2016. We are halfway through this month, and I think we headed into an interesting week essentially because in the week gone by, we've seen the Nifty actually not make a new high, whereas the broader indices, the mid cap index, did actually make a new high. So that essentially amounts to what we call an intermarket divergence, and we'll be watching whether that divergence continues to hold. As such, divergences are good signs of a impending trend reversal. Now, what has been happening essentially is that uh, we are not just looking at clues for what is happening in the domestic market, but also what is happening around the world. So global markets are going to be an important piece of the overall market perspective. We just can't ignore that, and I think almost everyone has come to tune on that, but often they take the individual view that our market is fine, and unless something happens anywhere else, we're all good. But the fact is that if you think that anything happening anywhere else has some weightage in your overall decision making, and if it's going to actually have an effect on what you think of the market, then I think you need to pay attention to that because, uh, say for example, is it going to just be a 5% weightage you're going to give to what is happening in various markets? Then you wouldn't really even mention it, the moment you're saying that, well, if something happens somewhere is going to play a role in your decision making, then probably the weightage is significantly higher, and in that sense you need to be aware of what's happening around the world as well. So what we are seeing this time around is, the US market, of course, has been the strongest among the world equities this time around, unlike what we saw in 2008, uh, when everything rolled over after the US market. This time around, many markets have been affected first with the rising dollar. You've seen most of the emerging market and commodity based currencies and indices actually sell off much more sharply last year, and then we've had a rebound rally from there. And in that sense, the US market, in terms of the Dow, essentially has made several attempts to come back close to its all-time highs, not really gone there. But again, there, if you do some intermarket analysis, you find, in broader indices like the NYSE Composite or sectoral indices like the transports have not gone much beyond the 61% retracement mark and have actually turned down just from that level. So what we are seeing is the fifth, weakest or rather negative earnings growth in US earnings itself. That doesn't get talked about so much if you really read day-to-day news on what happened to the US markets. But essentially, that's been a big turn, and this time around, you actually have revenues falling, which was a new feature. And which has been a feature even in our own market. If you've watched the last 4 quarters, we had negative growth, and this particular quarter we have some uptick. You'll need to wait and see the final numbers, and I'm of course talking about Nifty earnings. They were growing negatively for 4 quarters, and this particular quarter they're so far almost close to flat. But a few more results could twist it either this way or that way. And in a sense, if you're not having earnings growth in any case, then you're pricing in a lot on the upside on an average basis. Of course, if you go stock specific, you can say, well, this one is doing well and that one is not. Those variations have led some stocks higher and others lower. But on average, I think you're pricing in much more than you're not. So that's been essentially the case for the rest of the year. But again, you can argue, well, our market's been down for 4 quarters, so it's already priced in that degrowth. But compared to the level of growth, I don't remember a period when we've seen earnings not growing or growing negative, and you pricing in a historical 20 times earnings on a broad index. Say if you take the PE of the BSE 500. And so so that kind of variation has definitely never happened before. I've seen 12 to 13 times on an 8% growth. That has also been considered normal, but this is like a huge gap or deviation, and it has essentially led to buying in the same stocks over and over again, which is your same HDFC Bank, LIC Housing, key large cap stocks, FMCG defensive plays, which has made them more expensive versus the others, which is normally what you expect in a slowing economic phase. So we've not ended that because that theme continues to play on the market and has essentially led to the outperformance of broader based market indices like the BSE mid cap or small cap indices relative to the Nifty for more than a year. And that's a really extensive period for it to happen, because previously when the Nifty topped, maximum within a few months you would have seen a reversal in the mid cap indices. Usually it happens almost at the same time. If you saw 2008, in 2010, within a month you saw the relative performance fall back, and this time around it's gone on all the way till December. We've seen the last peak in the relative performance, and still we haven't seen a major sell off, although Jan and Feb were a pretty deep cut on the mid cap indices. The full reversal of that strength has not happened, and we are still seeing a retest of almost the highs in the broader indices, which means that if you just measure the retracement, the BSE mid cap index has retraced 78% of the entire fall it saw from July to Feb, whereas the Nifty has only done 50%. So that's the kind of difference that we are really seeing, and that's what shows up in the relative measurement. So the reason for that is that I guess distribution in some stocks has not happened. You have liquidity remaining high at a global level, which is continued to drive certain indices. You had positive sentiment. Now that would be unusual, but if you just look at the flows that continued all the way into December, and even do to some extent now in the domestic mutual funds and so on, that liquidity kept that enthusiasm or positivity showing up in the indices, and essentially reflects the positive sentiment at the ground level that people essentially looked at investing for the long term, and doing it through SIPs if they're scared of the market, but continuing to do it rather than not doing it, which kept some money flowing in and going into the same stocks that have been holding out for so long. So that continues to create a sense of optimism in the underlying market. But my reading is that unless you really get a complete reversal of these readings from extreme positive sentiment to extreme negative sentiment, which has not happened despite this 4-quarter decline in Nifty, this move on the way down is probably not complete, and which is why I've been calling this a bear market rally. Apart from that, the other reason being that the world markets that have seen a bounce back essentially on the weak dollar theory, which has seen a rebound in commodity prices, has mostly come to an end. So you've already seen the dollar starting to strengthen, and if you're watching the commodity markets, then you're seeing a lead indication coming from commodity prices, which are mostly the metals, going on the way down. And if you watched it long enough, that's always the case. Crude never leads the way down. Copper tends to always be ahead, and eventually you find crude leading, joining the move lower. So this week we actually saw a sell-off in most base metals, but crude made a last attempt and made one more new high by this weekend. And my sense is that's again some kind of an intermarket divergence between the commodity space that should see crude eventually rolling over, because you are now again heading into a period where the dollar is going to be rising rather than falling. I've of course discussed over and over in my posts that you have a long-term reversal in the dollar happening, but we've seen the dollar fall for several months now, and no trend goes on forever. Even if it's a longer-term trend, you get counter-trend moves. So this move up is either one final attempt at the dollar making a high, or it's just a counter-trend retracement. I'm keeping both options open. But in either case, it would be a multi-week or a 1-2 month affair at least, and that could keep the pressure coming back once again on the commodity space, on the emerging market space, and that's what you need to watch out for on the downside. And that, coupled with the weakness that we are seeing now in the US markets once again from the weak earnings quarter, which will start reflecting probably in prices, because this is just like I mentioned earlier, for our own markets being high on valuations, you have a similar situation in the US as well. If you have 5 quarters of negative growth and you're pricing in at over almost 24 times based on certain calculations, then you are pricing in a lot more than what you have on the ground. And till you see a reversal of that, there's a lot of room for you to really correct back from that point. We've seen A lead again coming from the transports, like I said, where the weekly momentum has already crossed to the sell side. And we are seeing minor lower tops and bottoms in the key indices like the Dow and the Nasdaq. The Nasdaq is, of course, leading the way down this time around, unlike the last quarter of 2015 when the Nasdaq was actually making it made its highest level on the Nasdaq 100 in December, and the Nasdaq Composite in the previous top in October. So those at those points the S&P was actually making a lower top, and this time around the Nasdaq is actually retracing much less than the S&P and Dow, and pointing lower. So you have these intermarket readings that are now showing weakness coming to the US market itself, and the rising dollar, which is likely to affect many other markets. So in a sense, what I'm saying is that the reflation rally based on the weak dollar into global equities is reversing, and what you're likely to see is probably weaker equities, a stronger dollar, weaker commodities, and that's likely to directly have an effect even on our own market, which in terms of Nifty has made a lower top this week, and what we'll be watching for is whether we get another lower bottom in the coming week, which then becomes a lower top, lower bottom trend reading, pointing to much lower levels from here on. One of the issues which is likely to continue is going to be our banking sector reform, rebalancing, restructuring, or refinancing. The entire process, you keep reading about it, and people try to anticipate that the worst is over, but my sense is if nobody knew that the worst was coming more than a year back, to essentially start saying that the worst is over would be too early or premature till you can really feel it in the numbers. And that means that once you only see actually a clear reduction in the amount of numbers adding up every quarter, you don't want to take that call, because either the management didn't admit it, or let's say without being too much into conspiracy theories, say that well, they didn't know, and if they didn't know, then they don't know even now. And that would go particularly to things like Axis Bank's numbers coming out and then pointing out that these are the list of potential defaults. That doesn't tell me anything, because to say that this is all that's going to happen ever would be misleading. And if they didn't know they were going to have these numbers a year back, how do they know that they're not going to have more numbers a year down the line? So you have to actually look at this whole story play out. The refinancing happened for the public sector banks. They've announced much more losses this time around. For example, just the last quarter, Bob appeared like the best case. They'd written off everything, and people thought the worst was over. It was the only PSU bank that went up when others were going down in February, and now suddenly it's announcing a lot more in terms of write-offs. So to repeat, this story is not over till it's over, and so it's likely to be something that's going to affect sentiment in the weeks and months ahead. And in the meantime, we continue to wait for a turnaround in actual economic data. I don't like looking at month-to-month data. Essentially, as you just saw this week, you suddenly saw a drop in IIP again. So if you thought the last 2 months were green shoots, well, here's a rude awakening. So you can't look on month numbers. These are things that you need to study on a multi-year basis, look at overall trends develop, and only then take a call that a trend has changed. You can't look at 2 quarters and say, well, things are improving, because that doesn't tell you anything. And the same goes with the whole inflation and interest rate cycles as well. And there's been a huge attempt to bring down interest rates, and to some extent it has appeared to happen, but not as much as you would have expected. And if you've seen the recent budget and the recent RBI policy, both of them attempting to move in that direction, but at the ground they're both very tight policies, because if you keep the fiscal tight, you're actually not spending much more than X, and that means you just provide for that limited growth, but not much more than that, so that it's not inflationary. And at the same time, RBI creates liquidity, but just as much as the banks are going to need on a month-on-month basis, rather than expanding it beyond a particular point such that it creates a reflationary or inflationary growth environment. So with both of those missing, you can't get the kind of kickoff that you'd really want, and therefore you need to continue to weigh and look at numbers for a couple of quarters before you actually get a turn. And in that meantime, global risks are going to be the key thing that will affect our markets, apart from the generally slow to flat growth that we are seeing already. So that's all in this update. Thank you.